a fire starts in the kitchen. The house is damaged badly enough that the family moves out for 4 months. The insurance company pays to rebuild. New kitchen, new drywall, new roof structure over that section. The house comes back. And the family still ends up thousands of dollars out of pocket, not because the claim was denied, it was approved. The detached garage was underinsured. The 4 months of rent were only partly covered, and the 12-year-old roof was paid at what a 12-year-old roof was worth, not what a new one costs. Every one of those is written in the policy they signed. And here is the part that makes this worth 20 minutes of your time. Not one of those 3 things was a decision made after the fire. All 3 were settled years earlier. On the day the policy was written, in numbers nobody read aloud, most of which were calculated automatically from a single figure. By the time the kitchen was burning, the size of that check had already been determined. The fire only revealed it. Home insurance is not one promise. It is 5, with 5 separate limits, and most people can only name the first. Hey, welcome back to Policy Unpacked. If you're new here, this is where we read the fine print so you don't have to, in plain English with no sales pitch. Glad you're here. Today, it's the homeowners policy. All 5 parts of it and the 2 mechanisms that decide what your check actually says. Quick ground rules first, then we dig in. Quick ground rules. This is general education about how homeowners insurance works in the United States, not advice about your specific situation. Coverage forms, limits, endorsements, and prices vary by state, by insurer, and by the exact wording of your policy. Every person and number here is a simplified, illustrative example. When it is time to act, the document that matters is your own declarations page, not this video. Picture your house. Now picture the policy as 5 rooms inside it, each with its own budget. Coverage A is the dwelling, the structure itself. Walls, roof, floors, the plumbing and wiring inside them, and usually anything attached, like a built-in garage or a deck. Coverage B is other structures, the things on your property that are not attached to the house, a detached garage, a fence, a shed, a gazebo. Coverage C is personal property, everything you would take with you if you moved, furniture, clothes, electronics, the contents of the kitchen. Coverage D is loss of use. If the damage makes the home unlivable, this pays the additional cost of living somewhere else while it is repaired, a rental, and the extra you spend on meals above what you normally spend. Coverage E is personal liability. If someone is injured on your property, or you cause damage to someone else, this responds. It is the same idea as the auto liability we covered 2 episodes ago, standing in a different place. 5 coverages. Now here is the part almost nobody is told, and it changes how you read the whole page. Coverages B, C, and D are commonly set as a percentage of coverage A, not chosen individually, calculated. Typical structures run something like 10% of the dwelling limit for other structures, and somewhere in the range of 50 to 70% for personal property. Loss of use is often a percentage as well, or a set number of months. T, U, which means one number on your declarations page is quietly setting 4 others. Do the arithmetic on a real house. If coverage A is $400,000, then other structures might be $40,000. If your detached garage would cost $60,000 to rebuild, you have a $20,000 gap, and you have it whether or not anyone ever mentioned it to you. That is the first structural reveal of this episode. Home insurance is not 5 decisions. For most people, it is 1 decision and 4 consequences, which puts a lot of weight on getting coverage A right. And here is the mistake almost everyone makes with it. Coverage A should reflect what it would cost to rebuild your house, not what you paid for it, not what it would sell for today. Those are 3 different numbers, and the gap between them can be enormous. Market value includes the land, and land does not burn. In an expensive city, land can be most of the price. In a rural area, a house can cost far more to rebuild than it would ever fetch on the market. So the number you need is a construction estimate, not a valuation. Materials, labor, permits, debris removal at today's prices in your area. And at today's prices is doing real work in that sentence. Construction costs move. A limit that was correct when the policy was written 5 years ago may not rebuild the same house now, which is why many policies include an inflation adjustment and why it is worth checking that yours does. Now the second mechanism, and it decides whether the policy responds at all. Insurance does not cover damage. It covers damage from a covered cause. The industry word is peril, and there are two ways a policy can define which ones count. Named peril means the policy lists what it covers: fire, lightning, windstorm, hail, theft. If your cause is not on the list, there is no coverage. The list is the whole agreement. Open peril, sometimes called all risk, works the opposite way round. It covers any sudden accidental cause except the ones specifically excluded. Here, the exclusions are the list and everything not on it is in. The common homeowners form in the United States, the HO3, typically writes the structure on open peril and personal property on named peril. There is a broader form, the HO5, which generally writes both on open peril. It costs more, and not every insurer offers it in every state. Read that again, because it is genuinely odd. Under the same policy, your house and your furniture can be judged by two different rules. Here is what that looks like in practice. A strange, sudden accident damages the structure. Under open peril, the starting position is that it is covered unless the insurer can point at an exclusion. The same strange accident damages your sofa. Under named peril, the starting position is that it is not covered unless you can point at a listed peril. Same event, same house, two different burdens. Think of it as two doors. One is open unless someone locks it. The other is locked unless someone opens it. Most people assume they have two open doors because they bought home insurance. One product, one word. And this is not a trick. It is printed, and it is why the phrase on the page is, "We insure against risk of direct physical loss," for one section and a numbered list for the other. It is simply written in a language nobody reads at closing. Let us run a fire through it. Every person and dollar here is fictional and illustrative. The Ruiz family owns a house with a dwelling limit of $400,000 and a $2,000 deductible. A kitchen fire causes structural damage, smoke damage throughout, and destroys the contents of 2 rooms. Coverage. A responds to the structure. Fire is covered under any standard form. This is the least controversial claim in insurance. Coverage. C responds to the contents. Fire is a named peril, so the sofa and the electronics are in. Coverage D responds to the 4 months in a rental, up to its limit. So far, this is the system working. Now the mechanism that decides the size of the check. Replacement cost value pays what it costs to replace the item today with one of like kind and quality. Actual cash value pays replacement cost minus depreciation, what the item was worth given its age and condition. The 5-year-old television, replacement cost, $800 for a comparable new set. Actual cash value? Perhaps $300 because it was 5 years old and televisions lose value. On a whole household of contents, that difference is not a rounding error. It is often the difference between restoring a home and partially restoring it. Which of the two you have is a choice made when the policy was written, and it can differ between the structure and the contents. And there is a detail inside replacement cost that surprises people even when they have the better coverage. Many policies pay actual cash value first, then release the remaining depreciation after you have actually replaced the item and shown proof. That is called recoverable depreciation. It is not a denial, but it does mean the first check is smaller than the final settlement. And a family that cannot fund the gap in between can find itself unable to claim money that is genuinely theirs. The claim was approved, the money still arrived in 2 parts, and the second part had a condition. Second scenario, because roofs are where more homeowners meet the fine print than anywhere else. A hailstorm hits. The roof is 14 years old. The adjuster confirms hail damage. 3 things in that sentence can each change the outcome, and none of them is whether the damage happened. First, the age. Many policies now settle roof claims on actual cash value rather than replacement cost once a roof passes a certain age, sometimes through a roof schedule endorsement that pays a declining percentage as the roof gets older. A 14-year-old roof may be worth a fraction of a new one. Second, the deductible. Some policies apply a percentage deductible for wind and hail rather than a flat dollar amount. 2% of a $400,000 dwelling limit is $8,000 before anything is paid. Third, the word cosmetic. Some policies exclude damage that marks the surface but does not affect function. Dented but not leaking can mean visible damage and no payment. Now stack them. A confirmed hail claim on an aged roof with a percentage deductible and a cosmetic exclusion can produce a settlement close to nothing, with nothing improper having happened. This is the honest heart of the episode. The moments people describe as being cheated are usually moments where the policy did exactly what it said, in language they were never walked through. And it is worth understanding why roofs specifically became the battleground, because it is not because insurers dislike roofs. A roof is the one major component of a house that is guaranteed to wear out on a schedule. 20 years, give or take, depending on material and climate. Every roof in the country is aging toward replacement, whether anyone is looking at it or not, which creates a genuine problem the policy has to solve. If a 15-year-old roof takes hail damage, how much of the replacement cost is storm damage? And how much is the 15 years it had already lived? Both are real. Actual cash value settlement is the industry's answer to that question. You can think it is the wrong answer, but it is an answer to a real question, not an attempt to avoid paying, and knowing which of the two you are dealing with changes how you argue about it. The failure here is not the mechanism, it is that almost nobody is told. The mechanism exists until the day the adjuster explains it in a driveway. 3 more places. The structure stops, and the first 2 are the largest exclusions in American home insurance. Flood is not covered by a standard homeowners policy. It requires separate coverage, commonly through the National Flood Insurance Program, run by FEMA, the Federal Emergency Management Agency, or through a private flood policy. And the definition matters more than people expect. Water falling on your roof and getting in is generally a homeowner's matter. Water rising from outside and coming in at ground level is generally a flood matter. Same water, different policy, decided by direction. Earth movement, earthquake, landslide, sinkhole in most forms, is likewise excluded from the standard form and requires separate coverage or an endorsement. Now, the obvious question, and it deserves a real answer rather than a shrug. Why are these 2 excluded when fire and windstorm are not? Because insurance works by pooling. Thousands of people pay premiums, a small number have losses. In any given year, the pool covers them. That only functions when the losses are independent of one another. House fires are independent. Your kitchen fire tells us nothing about your neighbor's kitchen. A flood is the opposite. When a river breaches, it does not damage one house on the street. It damages every house on the street simultaneously along with the next street. The same is true of a major earthquake. So the pool is hit for everything at once, and the mathematics that make ordinary insurance work stop working. That is why flood coverage in the United States ended up requiring a federal program, and why earthquake coverage is a separate specialist market. Not because insurers are unwilling, because a risk that arrives for everyone at the same moment is a different kind of risk. Third, sublimits inside your personal property. Even when contents are covered, categories that are easy to steal usually carry their own internal caps. Jewelry, watches, furs, firearms, silverware, cash. A policy can carry $200,000 of personal property coverage and still cap theft of jewelry at a low 4-figure number. The overall limit is real. The sublimit sits underneath it, and it is the one that applies. And notice the logic behind which categories get capped. It is not arbitrary. Jewelry, watches, cash, firearms. Small, valuable, easily taken, and extremely hard for an insurer to verify after the fact. An insurer cannot confirm what was in a jewelry box that no longer exists, so the form caps the exposure by category and offers a way to buy the cap away. Schedule the item, listed individually, usually with an appraisal, and it is covered for its stated value, which means the wedding ring in the drawer is covered to the sublimit. The identical ring, listed on a schedule with a valuation, is covered to its worth. Same object, same policy, different paperwork, which is the same shape as the auto liability trap from episode 3. A large number on the front page, a smaller ceiling underneath it that governs the actual event. There's a fourth place worth naming, and it catches people at the worst possible time. Ordinance or law. Your house was built to the code of its era. If it is substantially damaged, the rebuild has to meet today's code, which may require wiring, plumbing, insulation, or structural work the original never had. A standard policy generally pays to restore what was there. It does not automatically pay the extra cost of the upgrades a building inspector now requires. That gap is covered by an ordinance or law endorsement, and on an older home, it can be the difference between rebuilding and not. So here's how to use all of this. You do not need to become an underwriter. You need 6 lines on your own declarations page. Line 1. What is my coverage A, and does it reflect what it costs to rebuild today? Not what I paid for the house and not what it would sell for. Line 2. What are B, C, and D, and are they percentages of A? If so, work out the dollar figures and check them against your actual garage, your actual belongings, your actual rent. Line 3. Is my personal property replacement cost or actual cash value? This one word changes the size of every contents check you will ever receive. Line 4. What are my deductibles? Plural? Look specifically for a separate wind, hail, or hurricane deductible and whether it is a percentage. Line 5. Is there a roof schedule or a cosmetic damage exclusion? If your roof has age on it, this is the line that decides your next storm claim. Line 6. What is excluded entirely, and do I need flood or earthquake coverage where I actually live, not where you grew up, where the house stands? Pause here, open your declarations page, and answer them in order. If line 3 says actual cash value and you assumed otherwise, you have just learned something worth more than this video. The verdict on homeowners insurance is not that it is a bad product. It is one of the most valuable financial instruments an ordinary household will ever hold. The problem is the name. Home insurance sounds like one promise about one thing. It is 5 coverages, 2 valuation methods, at least 2 deductibles, and a set of exclusions that vary by geography. And the single most useful correction is this. The policy does not promise to make you whole. It promises to pay a defined amount for a defined cause, valued by a defined method, after a defined deductible. Every word in that sentence is a place where your expectation and your contract can diverge. None of this tells you which limits to buy. It cannot, and it should not. Your declarations page and your state's rules control your result. Read the actual coverages and ask your questions before the loss, not during it. Because knowing what your policy covers is only half of it. The other half is what happens after you pick up the phone, the adjuster, the estimate, the deductible, the 2 checks, and the words that decide how much of your claim survives the process. And that second half is where most of the frustration actually lives. You can read every line of this episode correctly, buy exactly the right coverage, and still be surprised by the size of the first payment. Because the policy tells you what is covered, and the claim process decides what arrives. Those are 2 different documents, and only one of them is in your filing cabinet. Next time on Policy Unpacked. What actually happens during a home insurance claim, step by step, from the phone call to the final payment. This is Policy Unpacked, how insurance actually works. No sales pitch.